What is going on, guys? This is obviously Jordan here, back in another video. My phone's blowing up as soon as I start recording this. And today, it's been about 4 months, I think, since I started. I made two funds on Trader 212. I think I might have made them in April. But either way, the plan was to have made... I've invested 600 the first time, and then another 600 during the interlude. And the idea was to have 2,000 to turn that into 2K, hopefully, by today. Well, not by today, but by September, or by the time I start third year. Obviously, the markets, but as soon as I invested, that was kind of like the peak. So things were a bit strange. I mean, I always knew that it's going to be very, very unlikely to make that much money in the stock market over like such a small time period. But because of the craziness that happened in 2020, we saw a lot of things going up, a lot of things going down. I mean, to be fair, pretty much everything went up in 2020. It was a very strange year for the financial markets, and for cryptocurrency and stuff as well. So I was like, you know what? It makes sense to assume it's going to continue, right? We made these two funds, invested in both of them. We still have about a month left before I have to sell them. Well, 2 months even before I have to sell them off and pay back loans and debts and stuff. Not through this challenge, but just in general. It's just nice to have money that I put aside, knowing that I was going to be spent eventually. But yeah, now that we're here, let's take a second to review how those funds have done in the last couple of months. Before we do this, actually, I'm going to show you my free trade account, because as I said, a lot of the money that I invested, even though yes, it was invested for the purpose of just long-term investments, a lot of the money that I had, I just threw in. I overcommitted. I put a video out before saying why I stopped investing. And that was essentially me saying that I overcommitted to the markets. I didn't make an emergency fund first. I didn't account for changing in expenses, because obviously as a student, you have student accommodation, which changes every year. So this year it was quite cheap. Next year it's not going to be as cheap. And I didn't account for deposits, agency fees, paying money up front, not having a student loan between summer and September. I should have known this by now. I've been here for 5 years. I just overlooked it, I guess. And yeah, I made a lot of mistakes, made a lot of risky calls that didn't pay off in my favor. A lot paid in my favor. This one didn't pay in my favor. But just briefly to show you guys, I sold off. If I go to activity, I sold off so much money, so many stocks, sorry, and withdrew it as £135.72. So it's not a lot. I'm obviously by no means like a millionaire or nothing, but I've sold off a lot of my stocks. I've got £52 left invested in Square, Xpeng, Global Clean Energy, Vietnam Enterprise, Tesla, and Pineapple Power. Most of these are down. Well, half of them are down. So I can afford to wait a little bit to see how the markets play out over between now and whenever I need more money, if I don't get a job. But yeah, that's essentially that. Going back quickly into 212, because this is where the funds are. These are just some ETFs that the app recommends. And yeah, as you can see, I'm also down here. So it's been a very tough crowd. The funny thing is, one of my funds, the one that I thought was more conservative, well, it's not really funny. That's the one that was medium to low risk, is up 5%. The undergrad survival fund. The do or die fund, I said do or die because it's super high risk. I really didn't know which way it would go. This one, of course, is down 10%. That goes to show why you shouldn't take risk if you can't afford to, at least. Thankfully, I could afford to take this risk, but it wasn't the best idea. So to show you this one first, obviously Tesla. Tesla's actually had a decent couple of weeks, but I think I bought it. One of the bugs with this app, you can see me tapping on each one, you can't actually review the chart, so I can't show you the Tesla chart from the pie. I've got to go back out and come back into something else. But Tesla right now is worth like 680, I think. I'm going to search it on my laptop in front of me. 650, so it's actually dipped quite hard in the last 2 days. But it is generally up, it's just not up compared to where I bought it at, which is more of the problem. AIG, Boeing, Hive, and Airbnb, those are my recovery stocks. I was really thinking, June 21st, we have a good amount of time to recover after that. But of course, in the UK, we didn't open up on June 21st. It's been delayed until July 19th, which is in 3 days from now, 3 to 16th. And even Boris Johnson himself, our Prime Minister, came out and said he's not too optimistic about it. We'll see how things go, So it's interesting. I do eventually think recovery stocks will, recover, hence the name. But yeah, AIG SA is still quite far down. Boeing still not doing very well. Hive Group, Airbnb. I think I've also got Rolls-Royce down here, 18% down. So there's a lot of... It's peak. It's peak right now, but we're hoping for the best when the market reopens. Virgin Galactic, that one really hurt me, because that one blew up at one point when... I can't remember what happened. They got not clarification. They were given permits, or the legal they were allowed to go to space. They were given the rights, permits and stuff. And Branson and Bezos have been doing this whole space race nonsense for a little while now. So the stock went like way up. And then before I had time to sell it off, well, I wasn't going to sell it anyway. The whole point was to keep this fund until the end. But it's cooled off a lot since then. Now it's only up 3%, which is basically, I'm at basically breaking even. I made 69 pence on that deal. Yeah, I'm currently basically breaking even. I'm hoping that obviously it will be up again by the time I come off to sell it. But yeah, that's interesting times. Hyundai or Hyundai, if you're American, obviously doing well. I told everyone, I told my boys, Kia and Hyundai, those are the two that are going to do very well. Those are the two, you know, traditional automakers that are seem to be more focused on EVs. I mean, Honda kind of have the whatever it's called, but it doesn't look very nice. VW have some nice electric cars, but then the actual miles are very low. They're quite expensive. So VW, I'm not the biggest fan, but yeah, Hyundai and Kia, those are the ones to look out for, in my opinion, at least for the electrification of vehicles moving forward. You know, seeing how EVs do in the future, I think those are going to be big players alongside the Teslas and Neos and stuff like that. And I mentioned Neo right here, up 7%. GHVI and MViz, those are two SPACs that I really thought were going to do well. They're not doing too well right now. I think that I do think they still will do well in the long run, and I'm still holding out for that September, you know, sweet gains by the end of this challenge. But right now, hey man, right now my bills ain't getting paid. The only real highlight, I guess, from this one is Tilray. So Tilray used to be Afria, APFA. AP8, is it H or an F? I think it was a H. APHA, yeah, Afria. Of course, a weed company, same as like Sundial Growers, SNDL. And at some point, they merged into Tilray. But what the problem with trading 212, that I've had a lot of issues with this app actually recently, that I should probably bring up to them, I just haven't yet. But Tilray, once Tilray, you know, merged or consumed, let's just say, Afria, usually what happens is if you have Afria stocks, they just become Tilray stocks. But through 212, they just sold my stocks, and then that was it. They just sold my stocks. So I was hoping to hold it for the long run, but they kind of sold it. I had to lose it at a loss, and in this case, because it was down at the time they sold it. And they never replenished it with Tilray stocks, so I'm not too mad. It was only like £5 or something, and it was quite a small amount. But it's still annoying. You know, I still wanted to see how that would play out. And that's why if I go to the top here, into overview, I've only got £584 invested, because yeah, that they took the rest of it out, and that kind of ruined the challenge a little bit. But we're still mostly there, so that's pretty fun. The only other one now, if you go into the undergrad survival fund, this one says I've made 41 pence in dividends, which I've actually taken out, I think. And this one says I've only invested 576, which is weird. Oh no, that's because yeah, another thing sold, which I'll show you in a second as well. So back to the top here. Apple, of course, doing very, very well. I'm looking forward to their event. Hopefully their event's in September before I sell the stock, so we have some time to see how that, you know, how up that goes. Whatever. Nvidia have been doing crazy numbers, man. Nvidia and Moderna, and I said at this point Apple, these are the three top ones that are basically just carrying me. At some point I actually did rebalance the pie. So what you can do in this app, if you scroll to the bottom here, it says rebalance. What that means is if there are anything that's up, based on the initial percentages you set them, like right here you can see Scottish American, it said 1.7 I gave it, Impact's 1.8, McDonald's 2.3, they're currently at 2.27 McDonald's, 1.7 Impact, so the one on the left is what they're currently at. Anything that's up and things that are down, you can rebalance it, so it will sell off the ones that are over proportionate, and then it will buy the ones that are under proportion, and that's just a nice way of, like, if you believe in the entire fund, you don't want to become overweight in one stock. Like, I haven't got Tesla here, but let's see, like Moderna is supposed to be 8%, but it's currently 10. You know, Apple's meant to be 12, but it's 14. So Apple, Moderna, and Nvidia make up such a large portion of this pie. If I wanted to rebalance it, I could distribute it more evenly. That way I'm not overly dependent on Apple. Like at this point now, if Apple comes down, that's really going to affect my portfolio. Whereas if I balance it out a bit more, as you can imagine, it won't have much of as much of an effect if Apple comes down individually. That doesn't really matter too much at this point. At the end of the day, like, I'm going to sell it in 2 months anyway. But yeah, that's a nice way to, one, hedge. So maybe if Apple's had like a good run, maybe you're expecting a sell-off, that's a nice way to hedge some of that profit, was to diversify a little bit more. But also you can see like Uber's down at the moment, 17%, Disney's down 2%, Cineworld's down 36%. Maybe like Cineworld, as the world, as the UK opens up in the next week, they might be bringing in way more money. People really want to watch the new James Bond, Black Widow, other films that are out now, Conjuring 3, Quiet Place 2. So maybe maybe their quarter, their third quarter is a lot better because of that. And maybe I can, instead of putting more money into this pie, I can just take the profits out again from the Apple, Nvidia, and put it into other ones. I'm not going to. Not today. Actually, you know what? Maybe I might, since this pie is up 4% anyways. Maybe I might see how things go. But yeah, I did that once, not long ago. And that's kind of why it's interesting, because Moderna, I must have made like £20 on that, sold it off, and it's up again another £31. It's pretty crazy. But yeah, it's double. Moderna's doubled for me. Imagine. So maybe it is time to like start shaking up a little bit. But yeah. Apple, Nvidia, and Moderna doing really well. Uber, I'm surprised Uber aren't doing too well yet. You'd have thought as the world slowly opens up, they start bringing in more cash, but I guess it hasn't been as nice for them as they would have liked. AMD, good quarter. I think the microchip shortages really affected Q1, Q2, and I think Q3 is going to be a bit shaky as well. But we can really expect end of September, end of Q3, to see how people react to that as well. How these businesses have maybe adapted to those times, if they've addressed their chip shortages. And that's really going to be the time where I expect Apple, Nvidia, and AMD to shine once they've got those supply chains all sorted out. Disney, I'm surprised Disney is still down. They've had people really enjoyed Falcon and Winter Soldier, WandaVision, Loki, all these like Disney Plus shows. But I suppose Disney Plus isn't their main source of income yet. They're still relying on like premiere nights and movie sales and tickets and merchandise. So we'll see how. Well, I don't know, because Black Widow is not the biggest film in the world. Spider-Man should be a bit more interesting because of course merchandising. But that's not going to come out until December, and by then we would have had to sell this. But yeah, I'm curious to see how Disney had, the type of year Disney had, especially with the whole reopening stuff. Sony as well, I kind of thought there'd be more PS5s out in the world yet. I mean, I kind of put out a video saying don't buy a PS5. So I did the opposite of pump and dump in the situation. I kind of screwed myself over in that stock. So you know what, now that I say it, go and buy PS5s. Greatest console of all time. And only buy Sony games as well, like God of War, all the exclusive Sony platforms, that get those ones. Nintendo as well. I'm surprised Nintendo is still down, especially that they just released the OLED Switch. So again, that's another one we're going to have to keep an eye on to see how that plays out. Between maybe now is a bad time to announce it, because it's summer. People don't really buy consoles in the summer. But when it gets close to the holiday season, nearer to Christmas, November, December, it's probably still a bit too late for me. But we'll see how things heat up in August and September. Again, even in this stock, even in this pie, there's not too much really to talk about. Impacts in asset management, I'm happy for those guys. In hindsight, I should have put in way more money there, but that's fine. Scottish American's up, McDonald's is up as expected, Rightmove's up. The only other interesting thing in this pie, similar to the other one, was Tilray was an M&A, a merger which went wrong. Ryanair, they're obviously still running, but they had this stupid thing because of Brexit where it's like they tried to limit the number of people that had Ryanair shares that weren't in the EU. So if you bought it before Jan 1st, I think it was fine. But if you bought it after Jan 1st, they just sold off all your stocks. And I didn't really know what to do about that. In hindsight, I probably should have rebalanced my pie before they sold that stock off, so I didn't have to lose the one that I had invested. Because basically there was like £30 invested in Ryanair, and the way they do it on this pie, if I show you now, invest or withdraw funds. So if I try to invest, it will say you need to have, the minimum I can invest is 58.83. I don't know why I was going to show it to you, but does it not tell me how to calculate it? It doesn't show me here. But the way they calculate it is the lowest percentage stock. So let's say you have a stock that's the lowest percentage as in how much you proportion out. So in this case it's 1.7% Scottish American. So it would be that 1.7% times whatever Scottish American's worth. Let's say the stock's worth £10, so it's £1.70. That times 100 is the minimum you have to invest each time. So it's like proportionate. I don't know if that makes sense to everyone. I hope that makes sense. It's just a way to make sure that your percentage is actually based on a value instead of just like 1% of what you put in. What does that really mean? And it's also to make sure that the minimum you buy, the minimum you can invest in each of these stocks is like a certain percentage relative to what the stock is worth. So if they do it based on the lowest one, that generally accounts for all the higher percentages anyway, because you're going to be putting more into it. But yeah, essentially in this case, I needed to invest like I just said £58 is the minimum that I have to invest for it to distribute evenly. and Ryanair sold off at like £30. So I had to either put £20 more in or just withdraw that 30, which I ended up doing. I just took it out and put that back in my bank account. As you can see, if I go into notifications, yeah, right here. So Ryanair sold off 2.25 at €15 each, and then the next day I sold off some more of my stocks that I had on 212. As I mentioned, I got bills to pay, and I withdrew £95.22 to my account, which I should get in 3 working days. Otherwise, yeah, that's essentially it. The main thing that I want to take away from this video is that, yeah, the main takeaway is that while last year was good and interesting, you know, while I was all bragging, oh yeah, I bought Tesla early, haha, the actual, you know, macroeconomics don't work like that. The actual stock market doesn't work like that. It is very much, in many ways, gambling. The great thing about making a pie or generally having funds of like collections of stocks is that you mitigate your risk. Instead of having all of your risk betting on like Tesla or Apple or Bitcoin or whatever your investments are, if you invest across a diverse range of things, you're hedging your risk in the sense that if one does really bad but the others do okay or not as bad, then your overall portfolio is kind of a bit more balanced instead of being heavily dominant on one stock. That's kind of the main thing that I wanted to preach when it came to this series. Well, it's not really a series, it's just like a thing that I'm doing, but it's nice to know that even though, you know, certain stocks aren't doing too well in one fund, and then in the other fund, certain stocks are doing really well, like Moderna, for example, we still have some amount of balance, which is nice. I mean, I think I'm down, what, 9%, and then up 5%, and my entire portfolio is down just 1%. But it's like, it could be so much worse or so much better, but there's no way to know in advance what, you know, who's going to go where, what stock's going to do better. So anyone out there who's investing, if there's anything you can take away from this video, is that diversification is important. Yes, it is possible to get a good stock at random. I could have just put all my money in Moderna and doubled my money, yes. But I also could have put all my money in Tesla and lost like 50%. That's, you know, also possible. So either, you know, be prepared to lose everything with a, you know, a proper risk, or understand that you can still win by diversifying. It's just about how much you diversify, and how much research you do beforehand. Like, if I had known that Afria merger was on the cards, maybe I wouldn't have invested in them. If I'd known that Ryanair and Brexit were going to do stupid nonsense, maybe I wouldn't have invested in them either. So it's about doing your research, making sure you know what's going on, and understanding again that you only invest where you're prepared to lose, and things can go either way. So a good portfolio always beats short-term gains, in my opinion at least. But with that said, that's the end of this video. Hope you guys have enjoyed it. As of tomorrow, we're going back to the, you know, picking names out of a hat and stuff. This was just a one-off. I wanted to kind of bring some sort of update, some sort of clarity, some sort of transparency for these funds, so you know how they're doing. But yeah, back to the normal timetable tomorrow, and I'll catch you in the next one. Peace.